Hello, I'm Stephen Dickens, CEO of Hyperframe Research, and you're watching Taking Stock.
We'll get out of this shot. All right, I'll see you in a
2 minutes to go until the closing bell down here on the trading floor of the New York Stock Exchange. How cool is that? We're at the New York Stock Exchange today.
You and me.
You and me, Peter
Back
Tuchman,
again.
the Einstein of Wall Street. Unfortunately, wow, we are at session lows. We've been watching the S&P 500 continue its selling pressure in the last hour, currently down almost 9/10. Peter, any sense here of what's been top of mind here? As we see a lot of red on the board.
There's plenty of red on the board. My gut is this feels like they've been setting this up for a little while, hoping that something good would come in as far as news goes or headline goes, and nothing is coming in. So I think it's tech is leading the way here. We got $1 billion sell program right on the post.
Wow.
That did not help anything. We've been sort of eroding the market, sort of felt like a confidence erosion all afternoon. One day doesn't make a market. It's never good when we actually close on the lows of the day. I'm not sure, we got a little bit of a pop here, but when you do that, you tend the next day, especially on a Friday, to sort of have a little bit of gap down and maybe a little bit of capitulation. But you know what, it's a feeling. I can't tell you that this is the beginning of something worse. It just felt like it, that the day sort of, it felt confidence was being eroded all day. I'm not sure where it's coming from.
Yeah, maybe a warning sign on the consumer from Walmart. Shares of Walmart down 9% all day today.
Correct.
That'll be a big one we talk
when
about.
that sector starts to erode, that's a bit of concern.
Peter
Anyway,
Tuchman, the Einstein of Wall Street. Thank you for being here.
Nix
M&T,
and five.
Bink, Nix, and 5 more taking stock after this. I'll state the obvious. It's one of those days I regret wearing red because I think the market is red because of me. Your final tail of the tape on this Thursday, August 20th. The S&P 500 down almost 0.9%. The Dow 30 in the red, 1.3%. Also finishing the tape at session lows. The New York Stock Exchange Composite Index down 0.6, and the small caps down 1.3. Energy and real estate, the only sectors in the S&P 500 in the green. They're not up by much. Everything else down and to the right. Healthcare, consumer discretionary, consumer staples, and industrials all down more than a full percent. The Dow has 30 stocks in it. Only 6 of them finished in the green on this Thursday afternoon. McDonald's, Travelers, and Disney, the House of Mouse, the outperformers. Most of these Dow 30 components, however, folks, deeply in the red, none more so than Walmart, down 9.1% after a big swing and miss in terms of sales growth. Sales are still going up, they're just not going up quite as strongly as they have for the last 6 years. Boeing and Home Depot down steeply as well. In the Mag 7, 7 for 7, all in the red. Amazon, the hardest hit name today, down more than 2%. Shares of SpaceX, meanwhile, in the red, 4%. Eric Criscuolo joins us now. He is market strategist right here at the big board. Okay, dude, we got a lot that we can pick from.
Okay, yeah.
It's been a surprisingly busy week for Treasury yields. Fixed income, not the splashiest part of our job, but we have to talk about it. They moved lower yesterday. The buyback program from Bessent didn't seem to last long. They kind of moved back up today. Do you view that as a headwind for stocks?
Yeah, I mean, the market equities have been concerned about the long end going higher for a while now. The 2-year kind of has been holding steady recently, even ticking lower as the price, as rate hikes have been kind of priced out of that area of the curve. But the 10-year and the 30-year especially have continued to rise in yield, and that is a concern overall for the market, especially equities. Bessent, like you said, he came out, tried to do some magic, some conjuring that we've been talking about on the Mac desk with my colleague, trying to get those yields down. It worked for a little bit on the 30-year, kind of basically erased all that drop from yesterday. Today they just came right back. So the market is telling you that they want to take yields higher. They're not believing yet in what the government is trying to do to get those yields lower. Bessent also said a lot of other things though about things he still has in his toolkit that he can deploy. There will be new announcements coming, so we'll have to see what he has coming up and just see how he wants to defend this 30-year and this 10-year yield right now.
Yeah, well, tomorrow is Friday, which gives us an opportunity to look ahead to next week. big earnings Wednesday afternoon. It's the biggest, arguably, of the season in video. You also got Jackson Hole coming up.
Yeah.
Talk to me about a few of those big, potentially market-moving catalysts you'll be paying attention to.
Everyone watches NVIDIA earnings now, right? They are the poster child, the poster chip for the AI trade.
Nice.
Been so for a while. They will obviously be very important. It's basically the commentary. We expect Jensen to be, to the moon. Everything is great. Demand is exploding. That's all kind of expected and priced in. So, there's going to be a lot of, trying to, read the tea leaves. What is he saying? Is anything changing? What's accelerating? What's not? So there's just going to be a lot of, devil in the details with that probably. Earnings are probably going to be great. Jackson Hole, again, getting back to the Fed, the Treasury, interest rates, that's going to be important as well. We're still trying to figure out Warsh's strategy, what he wants to do. We're hoping that he gives a little more color as to his strategy and maybe what some of these task forces are going to reveal.
Right.
Nobody really knows, and that's one of the reasons why yields have gone higher, because of that uncertainty. Investors don't want to hold long dated paper if they don't know what the policy is going to be going forward.
Yeah.
They'd rather sit in the short end and just collect their 4-ish% rather than go out to the long end and maybe be exposed to more interest rate risk, more duration risk. So we're going to see what he has to say.
You're not kidding. You got to watch those bond vigilantes. You can't fool the bond market.
No.
Stocks can get a little frothy from time to time. The bond market tells you what's
They
really
say
going on.
they're the smart
here.
ones, so I was never a bond trader, so it's probably right.
Yeah, that could be the case. Neither of us. Eric Criscolo, thank you for being here as always.
Anytime, my
Skylar,
pleasure.
grab your mic. I'll talk to you again soon. Bobby, pardon me. All right, here are a few of the top analyst calls that moved the tape this morning here on Wall Street you may have missed. First up, JP Morgan. Wow, it's wide open for me. That's awesome. JP Morgan initiating coverage on UMB Financial. It's a regional bank out of Kansas City, giving it an overweight rating, a December 2027 price target of $180 a share. Stock's up 27% year to date. Next up, Wells Fargo starting coverage on Progeny. It is a fertility benefits manager. Overweight rating, $37 price target. Shares of PGNY up 2% since the start of the year. Finally, Morgan Stanley upgrading Merck to overweight, lifting the price target to 179. Shares up almost 13% yesterday after that extraordinary move alongside Moderna. That was Merck's best day since 2009. That's the year I graduated college. That's quite some time ago. All right, how about the best performer here in the S&P 500? Nothing runs like a deer. John Deere reporting a huge beat on top and bottom lines earlier today. The company lifting its 2026 profit outlook as well. As you may know, there is a big construction boom happening currently for artificial intelligence. John Deere, a huge beneficiary of that momentum. Shares up on the day and up 35% so far here in 2026. Earlier this week, FinTech TV's very own Remy Blair sat down with CEO Thomas Healy of Hylon. They discussed their brand new U.S. Navy contract to power ships and to power bases. Take a look.
Hyliion recently announced a $41.7 million contract with the U.S. Navy to develop multi-megawatt versions of its Carnot power generator for unmanned maritime vessels. Now, this does represent the company's largest defense contract to date. And at the same time, the organization is attempting to leverage its modular power architecture for commercial use cases. Well, here to discuss the Navy contract as well as the commercial roadmap is Thomas Healy, founder and CEO of Hyliion. Well, good morning. Thank you so much for joining us. I do want to start out with that contract that was awarded to Hyliion. So what are the specific performance as well as maintenance requirements for these systems, and what is the timeline here?
Morning. So this contract is not only to focus on ships, empowering ships for the military, but it's also looking at powering military bases. And so the military needs a new source of power generation, right? They've been reliant on diesel engines for many, many years, but there's problems with diesel engines. They're loud, they require a lot of maintenance, they're not as efficient. And so those are areas that our Carnot power module are able to solve. And that's where they're seeing this as a future technology for them, even to the point where a brand new fully unmanned autonomous ship that the Navy is producing, the USX-1 Defiant, we are going to be the power plant on that because we don't require the same level of maintenance that a normal diesel would. And so that's one of the opportunities. You mentioned timeline. This is something that we are already building the unit for that unmanned ship I mentioned. And then over the next couple of years, we'll be delivering towards that $42 million contract.
Yeah, and Thomas, while I have you here, I would like to get your perspective on what we're seeing, especially given the demands of artificial intelligence. And as you highlighted, capacity constraints on the electric grid have increasingly driven interest in on-site power generation for AI data centers. So give us your take on to what extent power as well as efficiency requirements of these commercial hyperscalers actually align with the modules that you are building.
Maybe just to start with, to give your viewers a sense of like what's happening in the data center space. So if you go to areas like Virginia, which is where most of the data centers are in the US, or if you go to Ireland, the utility, the grid is already saying, we do not have enough power available. You have to go with this model of bring your own electricity. You can't plug into the grid anymore. And so that now forces the data centers down a roadmap where they're looking at, all right, what technology can I use on site that can make clean, efficient, reliable, and ultimately low noise as well, electricity, and ideally do it for cheaper or less than what you could buy from the grid. And those are all the value propositions that this KARNO power module that we're producing really enables. And so we are seeing a tremendous amount of demand out of the data center space. And right now we're working on how do we actually scale up in order to meet that demand, because these data centers are talking not about tens of megawatts, they're talking about hundreds of megawatts to even gigawatts of power that they need.
Yeah, and while we're talking about the KARNO system, for our viewers who may not be as familiar, tell us how the system actually runs, and in terms of fuel flexibility, how does it actually impact CapEx as well as operational costs for commercial adopters?
This is truly a new form of power generation. So if you think about technologies of the past, you have turbines, which is, big power plants are powered off turbines. You've got internal combustion engines, fuel cells. We are a new category of a heat engine, or based off of Stirling technology. Now, this isn't new. It's been around for 200 years, a Stirling engine, but the problem has been it's been extremely difficult to manufacture. So this is one of our key things. Just behind me here, you can see 3D printers, metal 3D printers. And we're actually using these machines to make parts that could never have been made before. And that's what's enabling us to bring this 200-year-old tech to life. And the benefits of it are extremely high efficiency, low maintenance, and you mentioned fuel flexibility. So since our generator is powered by heat, we can use natural gas, we could use hydrogen, propane in order to make that heat that then runs the system. So this gives, whether it's data centers or the military, a pretty unmatched advantage, because now you have one asset that can run on all these various fuels.
Well, Thomas, we will have to leave it there for today, but appreciate your time. Thank you so much for weighing in, and I appreciate your perspective.
Thank you.
Welcome back to the broadcast. Joining us now is Cory Klippsten. He is founder and CEO at Swan Bitcoin. Cory, always grateful for your time. So just 2 days ago, earlier this week, the SEC proposed brand new exemptions specifically for particular crypto fundraising. What are the key details of that announcement that we should know, and how significant a move do you think it really is from the SEC?
Yeah, well, first, thank you so much for having me on, and hello from Istanbul, here almost midnight, and glad to join you guys, especially on a day where the Bitcoin price, the one I care about, is up about 15% over the last day, so very exciting times. Yeah, so look, after about 7 years of altcoin VC funded pumping of crypto altcoins, so the non-Bitcoin crypto universe from like 2017 to 2023, they're mostly irrelevant at this point, and there's nothing really in the narrative across media, markets, journalists, bankers, anyone really trying to pump these altcoins. So it's interesting that this comes down now, because it's kind of like too late for those folks. Getting into the details, basically it's something like, with a lot of disclosures, they're allowed to raise something like $75 million with paper claims of doing some kind of decentralized network of some sort. And if they deliver it in those 4 years, there's kind of a grace period. And then it has to be, they have to have delivered at that point what they did, or they can't raise more money. And then there is a weird little exception as well, where with basically no disclosures at all and absolutely no requirements for the investor to be accredited and essentially no oversight, they can raise up to $5 million from the least sophisticated people in the world if they want to, and do basically the same thing. So, it's something, and I guess some crypto people will care. But I will tell you, the last time I was on a panel for a investment bank out in New York a couple of months ago, I was up there with 3 crypto executives, and the industry is basically bifurcated into just Bitcoin and crypto infrastructure, which is basically incremental improvements to financial IT. It's like Rails and payments and stable coins and things like that. And I would say that pretty much all the executives in the non-Bitcoin crypto industry are pretty much aligned with what I would have called a Bitcoin maximalist about 5 years ago. They just don't have any kind of thesis for altcoins. So I don't really think this is that relevant or interesting. And it's probably just kind of like throwing a bone to some of the people that funded over 50% of the campaign donations for the last election cycle.
Yeah, Corey, sadly, I'm short of time, but let's talk Bitcoin pricing. We did have a nice 2-day pop here. Where do you see price action going from here?
Look, we're kind of at that level where a lot has traded historically, right, in the kind of 73.1 to 73.8 range. That was the top after the ETFs launched in January of 2024. There was kind of a big Bitcoin price rise by the end of Q1 in 24 that topped out about 73. And then we pulled back and then ran up to like 108. And then there was a big pullback in mid 25. And it bottomed out at 73 as well. So it's a pretty significant level. I don't expect us to just punch through 73, 74 with no resistance. I think there's going to be a lot of people that kind of mark this level. But there's not a lot really between that and all-time high. There's like a little bit of volume at 80, a little at 88. Obviously, the 100K is kind of a round number. And then there's basically just the all-time high of 126 above that. So, I think we're in the early stages of Bitcoin bull market. I think the best thing to do for most people is invest in learning and understanding, buy what you know and don't just like chase the hot trade. But, I do think that Bitcoin price is much lower than what it's worth. And I expect that to be reflected over the long haul.
Yeah, there's no shortage of shiny things out there to go chase as a would-be investor. Always do your homework. And I'm always grateful for your time. Corey Klippstein, got to leave things there. Founder and CEO of Swan Bitcoin. We'll talk again soon.
Thanks for having me.
You got it, man. All right, folks, coming up here on the show, the latest news in the world of crypto amid BTC's big 2-day bounce back, plus my interview you do not want to miss with Cullen Roche. A whole lot more taking stock coming up right after this. Welcome back to the broadcast. Earlier today on the J.D. Durkin Show, Cullen Roche of Disciplined Funds broke down what he sees going on in the U.S. economy. No imminent recession, sticky inflation, and a weaker than expected labor market, and what all this means for investors. Take a look. The Roche recession rule. First of all, explain this to me. How might it differ from, let's say, the SOM indicator or other things that some market participants might be familiar with? And what is that recession rule telling you right now, Cullen?
Yeah, so this one, very, very, very famous rule, by the way, named by myself, for myself. No, I use this, it's really a labor market indicator. It's basically measuring the strength of really current jobless claims and the unemployment rate relative to one another. And what you find with this is that going back the last 50 years, this rule has never been under 50 during a recession. So it has a 100% success rate. And that's indicative of just the strength of the labor market. And so when you see this climb over 50, it means that there's a very high probability that we're already in a recession. And the NBER will dictate that this is an environment where this is definitely recessionary because the labor market is so weak. And right now, it's really interesting. Like, jobless claims are near all-time lows. I mean, you're not seeing the firing in the labor market that I think a lot of people probably would have been concerned about with the AI boom. But the thing that's so interesting about the labor market right now is that you're also not seeing a big boom. So even though there's a low probability of a recession, according to this rule, the labor market is actually really, really soft. And you see that in another chart that I sent you with we track real-time FICA withholding, which is, in our view, one of the best real-time metrics of how to actually gauge how strong is the labor market. So even though we're not in a recessionary environment right now, the labor market is by any metric incredibly soft. And I think that is interesting in the context of AI, because I think what we're seeing with AI right now is not a lot of firing, but you're seeing that firms are very cautious in hiring people. And so they've pulled back. The CapEx right now is all going towards data centers and investing in software and development. And it's not really going towards hiring new people. So I think firms are trying to get more out of the existing workforce rather than pulling new people into the workforce.
What would have to break, Cullen, for the recession risk to start flashing red for you?
I think that, well, the obvious one is always some sort of big exogenous shock. It would be something like some sort of geopolitical event. If some of these concerns in the credit markets, with some of the corporate debt issues and whatnot, turned out to be bigger than people expected. That's always the unknown. It's always the one that's sort of the unpredictable one. The more obvious one in this environment is just a huge slowdown in the AI spending and the CapEx. The sheer amount of money that is being thrown at this creates, I don't want to say recessionary risk necessarily, but it creates this sort of boom bust cycle that's kind of a classic phenomenon across, all economic cycles that are especially credit driven. And right now we're seeing that, where the last few years have been especially strong in large part because these big firms are just throwing so much money around that it's making the economy look a little more vibrant than it otherwise would.
So a follow-up I hadn't planned to ask you. Does that concern you when we got that report from Alphabet a few weeks ago, the first negative print for free cash flow in company history relative to how much it's spending on AI and data centers versus what it takes in? Or is that just kind of par for the course for the particular environment we find ourselves in?
Yeah, I mean, it's virtually impossible. I mean, they're spending so much money. I think that it's virtually impossible to predict when when everything starts to turn here. The Walmart report this morning actually was a little more worrisome to me, because that's indicative of a broader slowdown in the consumer potentially here, where you're starting to see a knock-on effect of all of these different things, because you've got the AI energy related problems are flowing through into inflation. You've got the Iran war that's just continuing to put pressure on oil, and that's flowing through on year-to-year CPI and putting upward pressure on prices in general. And all of this is starting to bleed through to consumers. And so you're starting to see an effect here where the consumer is a little bit soft, and you've got already the labor market is not necessarily negative, but the labor market is soft as well. And the linchpin in all of this continues to be these big, tech firms continuing to do huge amounts of CapEx. And Yeah, any sign of a slowdown there, I think puts downward risk on not only the economy but also the financial markets, because ultimately the financial markets have priced in very, very aggressive and optimistic future growth for especially technology, but also stock prices in general are very expensive historically in the United States.
I'm Scarlett Sieber with Money 2020, and this is Hindsight 2020. Let's rewind the clock back to August 22nd, 1996. Banks begin taking one of their first meaningful steps into the internet. The idea sounds obvious now. Check your balance online, transfer funds online, manage your account online. But in the mid-1990s, this felt revolutionary. For generations, banking happened in a branch. Yes, those things still exist today too. You went to the bank didn't come to you. The internet changed that though. And while the technology was primitive by today's standards, the strategic shift, it was enormous. Because once banking became digital, convenience became a competitive advantage. Customers no longer compared banks solely on trust or rates or branch locations. They increasingly compared the experience. Was the website easier? Was information available faster? Could transactions happen without waiting in a line? This simple shift would eventually create the conditions for fintech. Because once consumers got comfortable managing money through a screen, entirely new business models became possible. Digital banks, payment apps, investment platforms, neobanks, all of that, the foundation was set. Let's fast forward to today. The branch still exists, but for many consumers, their primary banking relationship lives inside an app. August 1996 reminds us that transformation often starts with something small, not a new financial product, a new customer expectation. That is your Hindsight 2020, because once convenience becomes available, it quickly becomes expected. With that, back over to you.
Tomorrow, Friday morning here on Wall Street, we will get the latest quarterly results first thing in the morning from the team at BJ's Wholesale, and at 9:45 a.m., just 15 minutes after market open, the latest data from U.S. flash manufacturing and services PMI for the month of August. Your final tale of the tape on this Thursday, August 20th, the S&P down nearly 0.9, the Dow in the red 1.3, the Stock Exchange Composite Index down 0.6, and the small caps down 1.34%. Thank you for watching this Thursday edition of Taking Stock live from the trading floor of the New York Stock Exchange. Have a great Thursday night. We'll see you again tomorrow.